Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of the investment firm Wilsey Asset Management. Great to have you here today. We got some important things to talk about. We're going to start off talking about what the recent changes in Venezuela means for the consumers, about U.S. consumers, and probably also to consumers in Venezuela as well. It is a new year. Is it time to hire or change to a new investment advisor? A lot of times you have those resolutions. That could be one of them. We'll talk about what to look for, what to look out for, what to look for, and so forth. We'll go over that. And then, well, the labor market ends the year on a soft note. We'll go over that. Is that a problem going forward? We'll tell you yes or no and tell you why. Chase, what do we got for companies today?
Yeah, so companies we're going to look at closer includes Tyson. You know, there's been kind of an update to the food pyramid for the first time, I guess, in several years. So we'll kind of look at a food company. Also, too, more news, political news, I'll call it, updates to the dream defense budget from President Trump. We're going to take a closer look at Lockheed Martin. And other two companies we're going to look at here includes Generac and then also Seagate Technology. So excited to break down the fundamentals, giving you an idea if we think it's a buy, sell, or hold based off the details we see here.
Exactly. Well, let's talk about the recent changes in Venezuela and what it means for the consumers, U.S. consumers, again, Venezuela's consumers. Without getting to the benefits of less drugs coming into our country, there are economic benefits from the large amount of oil reserves that are in the ground of Venezuela. The current daily consumption worldwide of oil is about 100 million barrels per day. That's 100 million barrels per day across the world. Venezuela has in their ground over 300 billion barrels of oil. That's a B with a billion. That alone would keep the world supplied for over 8 years. Just their own oil that could keep the whole world going on oil just for 8 years.
Yeah, I mean, they do have the highest proven reserves in the world, even above Saudi Arabia, which I was kind of surprised by that. Mm-hmm. And Venezuela actually accounts for about 20% of the world supply of oil. And that's not, again, an ongoing supply. Right now, they're only producing very little, under actually 1 million barrels a day. I think that's around 1%, obviously.
Yeah, I've heard as low as 700,000.
Yeah, I mean, I think last year they averaged somewhere around that 1 million barrels per day. So they're around that 1% production currently, but those proven reserves, again, about 20% of what we can see in the world. I mean, huge discrepancy there. Give you an idea of the numbers, Venezuela has 4 times the reserves compared to the U.S., yet in 2024, the United States produced over 13 million barrels per day, again, compared to Venezuela's around 1 million. And I think the Saudis are somewhere around 10 million barrels a day. So again, the most proven reserves, but a very low production compared to what they have in the ground there.
Yep. And there is talk about the big oil companies could be going into Venezuela, and that could definitely increase that production by a huge amount, which would benefit not only Venezuela, but also the world markets and the United States consumer. The way the United States consumer would benefit is from lower gas prices at the pump, and with oil currently trading around the high 50s, we'll call it, we could see that drop to the low 50s, maybe even below that, and that just means less at the pump. Chase, we are in California. Probably won't happen for California, but the rest of the country we're talking about as well.
Yeah, and the thing I look at, too, is we kind of just getting this news here, but President Trump did meet with oil companies on Friday, and he's now saying that they will spend at least $100 billion to rebuild Venezuela's energy sector. There's estimates from this group called Rystad Energy. This is the only estimate I've seen, but it says it will cost more than $180 billion through 2040 for Venezuelan production to reach 3 million barrels per day. So obviously, this infrastructure has to be somewhat outdated. I think Chevron's really the only company there that has some type of footprint. I kind of thought this was funny. Well, not funny, but interesting, I'll put it that way.
Better word.
Exxon came out and said, we've had our assets seized there twice. So you can imagine to re-enter a third time would require some pretty significant changes. You got to remember back in 2007, the company exited the country after the former president, Hugo Chavez, just seized their assets.
Yeah.
They just took them. So there has to be some type of benefit, I guess, for these companies or protections for these companies to go in there and be like, I don't want to invest, let's say, $20 billion and just lose all of that investment.
And it's funny you talk about seize the assets. Well, it's funny they seize the assets and the assets seized up because a lot of those assets are rusted. They're not working any longer. They spent no money on maintenance. That's why it's such, I think you said the number was 180 billion, because the infrastructure is there. But it sounds like everything has to be replaced and rebuilt, which is a positive to some degree, because production for oil companies now, they're much more efficient than they were back when they got that equipment. So that's a benefit. But the thing I didn't like hearing, I think you said 2044, 3 billion barrels a day. Was that what you said?
I think it was 20. Let me see. Gosh, 2040. Yeah,
2040.
2040 to reach that 3 million barrels a day. So I mean, that's a 14-year time period. I don't know if it's going to take that long, and I'm not an energy expert, and I don't know much about Venezuela. I think a lot of these companies don't know much about Venezuela right now either, because they've probably been pretty unknown, I guess, about what is happening in that country, given that regime down there under Maduro. So, I mean, it's going to take some time. It's going to take some analysis. I think it's too early to give an estimate like that, to say 180 billion over 14 years. I don't know. I think we need more information before actually giving firm details on that.
Yeah, that just seems like somebody's opinion, which I think is, I don't think that's accurate. I'm not an oil expert, but it just seems illogical that you would spend all these billions of dollars and have over a 10-year time return on your investment. That just doesn't make any sense to me. I think that's way too long.
I agree with that, and I think especially you get Chevron full force down there. Right now it's very limited capacity, but you get a Chevron down there, you get a Halliburton, Schlumberger, you get the full force of the American companies down there. I would be shocked if it took them that long to figure out how to get oil out of the ground.
Right.
I mean, that's the thing. They're not going deep into the sea looking for this oil. They know it's there. It's going to be a much easier investment. So yeah. I think this is just the tip of the iceberg in terms of getting more news on what this Venezuela situation is going to look like. I think the bigger question is, how safe is that investment? I think that's going to need to be the answer for these companies before ramping up production.
And I think it's going to put a lot more money in consumers' pockets, right? U.S. consumer?
Yeah, I mean, I think that's the thing we look at right now is this is just all positive going forward. As I said, Venezuela is such a small player in the U.S., not the U.S., but the world oil market right now in terms of ongoing production. So anything coming online will be a benefit, which, again, should help with oil, gas prices, again, outside of California. But that should help, again, the U.S. consumers' pockets, but also, too, it should help the Venezuelan population as production of oil would create many good-paying jobs. Again, you're talking about hundreds of $1 billion potentially flowing into that economy to create those jobs, and could lead to a ripple effect for other businesses with more money coming into their economy. The recent events, again, just occurred just a few days ago, a week ago, and a lot has yet to be played out. But make no mistake, there are many benefits if Venezuela can produce more oil for the world. And I don't know how Trump is going to do this. He makes a lot of these deals and he says things that you're like, how's that going to work? But I know he said they're going to get the oil, sell the oil, and then Venezuela is going to be buying U.S. goods with that oil. And we'll see.
Yeah, the whole thing, that ripple effect, I think it's more of a wave effect, because you spend even $100 billion down there to get things going. That's going to create other jobs where you've got restaurants going to start opening up. You've got movie theaters. You've got shopping. You got so many things, because people will then have money to spend, which they don't have now. And the other thing, I forget, the rapid inflation they're having now is just destroying the economy. That will probably reverse down and be more normal. So it will get them. Won't happen in February, but I don't believe it'll take 14 years either.
Yeah, I mean, that's my big concern is I just don't know enough politically about how you can take out Maduro. And then we've seen this before in other countries, other systems, where you remove the head of the snake, so to speak, but then it regrows a new head. So it's like, is there going to be a chance for stability, or somebody else going to rise and kind of take Maduro's shoes? I hope that's not the case, but I think there are more questions to be answered, again, before these companies feel safe.
And the Venezuela people, they really want this.
Yeah.
I mean, they were cheering when this happened and so forth. So there is somebody else here that might want to try to step up, but I think they'll be out of the picture right away.
I hope so.
They're not going to last. Yeah,
I hope so. That would be great, again, for us, for Venezuela, and I think the world.
Yep, exactly. Well, it is a new year. Is it time to hire or change to a new investment advisor? With a new year, investors should take a look to see how their investments did and have done, and how their investment advisor has been working with them. The beginning of the year is a fresh start, so it's time to see what your percentage return was on your portfolio in 2025 and evaluate your advisor. Do they keep you updated? Do they give you the customer service you want? Such things as returning phone calls in a reasonable time frame. It's a new year. This is many times a resolution for people like, oh, I gotta do well on finances. Well, here's a great place to start. Make sure you're getting the service you need.
Yeah, and I think we point out a good thing here, but you don't want to jump from the pan into the fire. So when you're looking for a new investment advisor, sometimes you leave one and you go to a worse one. Don't want to make sure that's the case. Be sure that the company and the advisor are full fiduciaries, which means they must do what is best for you, not what is best for themselves. We point this out all the time, but the hybrids, those are the most dangerous in my viewpoint, where they can tell you they're a fiduciary, but then go ahead and sell you an annuity with high commissions for themselves that isn't suitable. Or again, those alternative investments, which we talk about a lot. So make sure they are, again, those full fiduciaries. Ask yourself that question. Is the advisor trying to sell me products that he or she makes a big commission off of? Because again, that could be a huge red flag that they don't have your best interest in mind. I'll tell you right now, we don't sell any alternative investments. We don't sell any annuities. I just don't think they're the right place to be for most investors.
Right. And it's also important to understand the investment strategy of the firm and the advisor that you're going to use. Do they use mutual funds? Do you build your own portfolio of individual equities and investments that are liquid? And very important, don't tie your money up for years to come in the case of an investment does underperform. We've seen, unfortunately, these private equities, these alternative investments, they tie your money up, and it's a terrible thing to do. You want to stay liquid, and again, you always want to pick the best investment. But if for some reason that did fall or have some problems, you look at the fundamentals, oh, they're not good any longer. I need to sell it. You can get out. Some of these other investments, you can't. You're stuck until they tell you you can get out. I always believe it's worth asking the advisor how they manage their own personal portfolio. My feeling is if it's good enough for them, why is it not good enough for you? I know some advisors say, well, we have different objectives, but I think everyone does have the same objective of making a reasonable return on their investments. And I came up with this back in the 90s when I first opened this firm. I thought, well, gee, if it's good enough for me to buy because I want money, shouldn't I buy it from my other clients? And I've been doing that for, going on 30 years now.
It's funny. A lot of people say, that makes sense.
Yeah.
But a lot of advisors don't do it, so I don't get it. And the other thing, too, I want to point out, again, back to those alternative investments, is we actually just had a new client bring over a portfolio, and a third of the portfolio is in interval funds or alternative investments, which we cannot liquidate. Right. And that is the thing, too. When you're thinking about engaging in a new relationship with an advisor, if they have that approach, think about if you don't like that approach a year from now. Well, it doesn't matter. You're stuck now in the investments that they chose. That is just why I don't think it is going to be good for people in the long term, especially it makes it harder for you to change if you're not happy with that advisor and their approach. And also, too, lastly, don't be afraid to ask how they get paid when managing your investments. It may seem like an uncomfortable question, but if it's an excessive amount, that can be red flag. Also, too, if the advisor is trying to dodge the question, that means to me they're trying to hide something from you at the very beginning, and you should run away immediately. Take your time to find the right advisor. If you feel pressure from constant phone calls and high-pressure sales tactics, you probably want to look for someone else to work with on your investments. And we always tell people our sales close does it make sense to you? Yeah. There's never, again, you needed to sign the paperwork now, and I think there are so many sales tactics that to me are very off-putting.
Yeah, and we do have, generally you call a week later saying any questions you have, do you want to come with us or not? If great, we'll do it for you. But I've heard people saying, gosh, I couldn't get off the phone, I couldn't get out of the office. I mean, there's some high-pressure sales tactics out there because they want to make those big commissions. And it's just such a shame that happens because many times those guys are the ones that put you into these alternative investments that you can't get out of. And it's just, that's why I think if you look at, are they a fiduciary, that will eliminate probably 2/3 of the problem. Yeah. So very important there. So I think it's important to know because we've seen, unfortunately, people come through our doors. And I never forget, probably a year or two ago, we had somebody come over. They had the money in annuity, and it was like 20 years, and it still did not double. Yeah. We've seen some terrible things, and it's just if you made that resolution or you're thinking that, I just don't know, check your portfolio. How did it do? And if the advisor that you're talking or broker that you're working with, if they can't give you that number, I've heard this too, they won't give you. Oh well, you don't need that. Don't worry about performance. Like no, that's your only gain. You have to measure how you're doing compared to other things as well.
Yeah, so. No, I mean it's important. A lot of times they might not know, and then they have to pull in the third party advisor, which always is interesting to me too.
Yeah. So hopefully that helps out to get you off to a good start. 2026. Speaking of that, the labor market ends the year on a soft note, better than I thought it could have been, so I'll say that. But the jobs report was special considering it was the first time that it was on time in 3 months, but I'd say the data was, well, lackluster at best. Non-farm payrolls in December increased by only 50,000. At least it was an increase. It was short of the estimate of 76,000. The 2 prior months also saw downward revisions that totaled 76,000, so about 35,000 each month there.
Yeah, and the big one was actually October was a big revision, and then November was pretty small.
And we talked about that back in March and April. Said wait till October, November hit. You're going to see some big.
When the revisions, I think, were so big in October because obviously the government was shut down, so it was hard to get all the data properly. But interesting thing now is the books are closed on 2025, so we can look at the full year, and payroll employment grew by 584,000, which equates to a monthly average of about 49,000 new jobs per month. This was less than 2024's gain of 2 million jobs, or about 168,000 per month. And I was kind of surprised by this, but it actually registered as the worst payroll growth outside of a recession since 2003.
But it's so important to remember that when you get down to a 4.5% level from employment, you're really scraping the bottom of the barrel. There's people that say, nope, I'm just not going to work. I'll collect unemployment, and when it runs out, I'm fine. You've got to realize, I think you'll probably never, I think maybe it has gone below 4% maybe once over time, but it's just like that's to try to lower the job rate now is so hard because you pretty much have full employment now. You want a job, it's there for you. Mm-hmm. So don't think that, that 50,000, that sounds terrible, that 168,000 per month, versus 24. Well, yeah, because you had more openings back then. So you got to look at the numbers. You got to understand the numbers, as I always say. While this all might sound troubling, it is important to remember that changes to government jobs had a large impact on the data. Since reaching a peak in January, government employment fell 277,000 jobs. I want to point out that's a good thing because it means the government's spending less on payrolls. That's a positive for the taxpayer. This also created a huge headwind for headline payroll growth.
I mean, very simplistically, most years government employment increases. Mm-hmm. So not only should you add maybe that 277,000 back to the 584, but maybe even a buffer of, let's call it 40 to 50,000. So, I mean, you add back in 300,000 jobs from that government anomaly. Now you're at 884,000 jobs created for the full year, which is going to be better, of course, than that 584. So that government situation was just really an outlier that I think distorted the numbers. And as we always say, a number means nothing at all unless you analyze it and have something to compare it to. And that is kind of what I'm looking at here with the government situation. Not as bad as you pointed out. Also, I do want to be clear, though, that the labor market was still in a slower growth environment. Even if we do factor in the changes to the government situation, that was a slower year than obviously 2 million jobs created in 2024. But the thing that I just look at, you kind of alluded to it already, is that things probably aren't going to change this year. We are still going to be in a slowing labor market because that unemployment rate of 4.4%, it's hard to find people to work. And it's also important to remember that of those counted as unemployed, about 26% or 1.9 million people are considered long-term unemployed. And I love to point that one out as they have been jobless for 27 weeks or more. And I just got to say, I do wonder, how actively are these people looking for work? Because when you're a part of this survey, they call you and say, hey, are you looking for work? Yeah. They don't ask you, well, have you filled out resumes? Have you done 5 interviews? There's none of that. It's like, yeah, I'm looking for work. So, how accurate is that? And again, to have that amount of the population, of the unemployed population, to be long-term unemployed, I think that 4.4% is even light in terms of how healthy the market is.
And I do want to point out that a slower labor market like we're going into now with unemployment so low does not mean, a slowing economy. And also do want to point out that many times past administrations, I won't point out which ones, to increase the job market, they would do the opposite. They would actually make more government jobs for people. But in terms of areas of strength in the report, both healthcare and food services and drinking places, which I just call them bars. I don't think they call them drinking places. They did remain healthy. Healthcare employment was up 21,000 a month, and for the full year, average monthly gains of 34,000 jobs. This was down from 2024's monthly average of 56,000, but still pretty strong. I can't say it's not a bad number. That's a strong number. Food services and drinking places, again bars, saw employment grow by 27,000 jobs in the month for the full year, average gains of 12,000 a month. Again, these are all gains in these areas, which was similar to 2024 average of 11,000 jobs added per month. So again, some good places there, and you want to know where the jobs are. And I'm glad to see them in healthcare. The drinking places, as we call them, food services, those are your restaurants. I mean, people are out there spending money.
I was going to say, I don't really care about the healthcare. I think that's less indicative of the economy. I've talked about how it's kind of somewhat more government adjacent. You need those healthcare in good times and bad times.
Yeah.
I think that food and bars, that's where you're really going to see how healthy is the economy, because people aren't going to be eating out if things are bad, and always point out that number. It's good to see that, because I think that is truly indicative of the health of the consumer.
You do know we have a couple of healthcare companies in our portfolio, right?
It doesn't matter. I said in good times or bad. You should almost always have that growing population, especially considering our aging population.
Yeah.
You're going to need it. What I'm saying by that is not really indicative of the economy and the health of the consumer. Right. Because even if the economy were to slow down or decline, I bet you healthcare would still be increasing in jobs.
That's why it's in our portfolio.
The last thing to kind of point out here is retail trade was the real headwind for the month, as employment declined by 25,000 jobs. So that really kind of hurt the headline number. This could potentially be due to seasonal changes, but it was interesting to see that retail trade employment showed little net change in both 2024 and 2025. I was kind of surprised by that. And then also looking at other industries in the month of December, well, they showed little to no change. We're talking professional services, construction, manufacturing, very, very little changes there. Again, overall, I got to point out, I do believe this continues to show that we remain in a slow hire. People say no hire, no fire. I don't think that's the case. I'm going to call it a slow hire, low fire environment.
I like that.
And I don't see much evidence, again, that will change in 2026. The economy, I think, is going to be very similar to what we saw last year.
Yeah. So I think overall, good stuff. And we're going to point out, because I know there's other people like, oh, that's terrible. No, you got to understand the numbers of what's going on there. So all this information does come from our newsletter, goes out every Friday at 5 o'clock. Other topics in there were logical proof that silver could be in a bubble. Tesla is no longer the top seller of electric vehicles. That all-time favorite Kraft mac and cheese, well, it's losing market share. And would you own a humanoid robot? And if you can't afford the new truck or car that you want, maybe you should finance it with a 100-month loan. Yes, they're real. You'll see that in the newsletter. It is free. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Right in the middle of the page, sign up. Free. Get it every Friday at 5 o'clock. It goes out. All right. You want to talk about a company?
Let's do it.
Let's do Tyson Foods. You want to do Tyson Foods first?
Yeah, let's look at Tyson.
All right. Tyson Foods, their symbol is TSN. They're in the farm products industry. I was kind of surprised on that industry. We do see that the short on the float is only 3.5%, 90% institutional owned. The PE ratio, very disappointing, 43.6 versus 17.5. Price of sales looks good at 0.4, same as the industry. Price to book value 1.1 versus 1.3. Price of cash flow 9.6, above the industry at 7.3. And you want these valuation ratios lower than the industry average. And then the PEG ratio does look good, though, 3.5 versus 14.6. And that shows what you're paying for the future growth of the company. Now, Tyson has been struggling for quite a while now. We do see over the last year their earnings were down 55.1% when the industry was down 0.5%. Sales were up only 1.5%, about half the industry growth at 3.3%. And the analysts, not hot in the industry or Tyson, but they say the 5-year earnings per share growth estimate about 4.4 for Tyson versus 6.6 for the industry. Now, Tyson does pay a decent dividend at 3.5%. However, because of all the troubles, their payout ratio is about 146%, which is pretty high. Maybe that will change. Could be some write-offs in those, but I still would kind of question and be careful that could they cut that dividend to maybe save some costs. So be aware of that. Also, too, the current ratio does look good, though, 1.6, not as good as the industry at 2.3. Debt to equity 0.5 versus 0.7. We do see a net profit margin of only 0.9% for Tyson Foods versus 2.5% for the industry. Return on equity 2.6% for Tyson versus 6% for the industry. Those not looking very good. And the free cash flow is positive. It's about a billion two for Tyson, about the same as the industry. So you like to have that free cash flow during those difficult time frames. Jace, what do you got?
Yeah, I was going to say before I get into the numbers here, kind of pointed out at the beginning of the show about the changes to the food pyramid. And, it's I think it's a positive, but I'm going to say a light positive for a company like Tyson. The change is really kind of prioritizing, meat, whole foods, food like beef, chicken, things
Pork.
of that nature. So I think it would be positive. But the thing that I always joke about with you is I don't think it's really going to change for people. People, when they drink a Coca-Cola or they eat a Twinkie, they don't think they're being healthy. They just do it because they want to do it. So I don't think anybody really looked at the food pyramid before, and I don't think it's going to change going forward. So I think, if anything, it's a light positive to Tyson, but not major.
And you're right. And I don't think they looked at the food pyramid before. I think I remember seeing that in the 6th grade. And you don't, like, every week, like, what's the food pyramid? I mean, it's just something you eat what you want to eat. Again, there's people like us we try to eat healthy and so forth. But there's, 360 million people in our country. You go to places down south and stuff, they love their fried food.
Well, and I will say the one benefit is I think before this report, I think the old one was like 250 pages. The new one's 10.
Wait, the pyramid chart was 250 pages?
Well, there's a pyramid chart, and then there's like all the guidelines and recommendations. So now it's only 10 pages. So you might actually be able to read this one, the 250-page document. I bet you most people didn't. So we'll see. But we'll get back to Tyson real quick because we're running short on time. Current price here for Tyson, $58.03. 52-week range low here, $50.56. And the high, $64.36. It's been a rough performer in the last 5 years, down 11%. Over the last 10 years, it's only up 11%. So it hasn't really done much. Going forward, though, for the company, we got to September 2027. I see estimated earnings per share of $4.38. We do get a target sell price here, $72.71. So the valuation looks interesting. I think this company's had some problems. Beef, we've talked about beef before. We're, I think, at the lowest herd supply since the 1950s.
Yeah.
I think that's been a big challenge for them. Also, too, their CFO, I think, was definitely the definition of nepotism. He was part of the Tyson family, and he's no longer the CFO.
Oh, he's gone.
Wow. He got a DUI. He was drunk and showed up in his neighbor's house. I mean, there's this list of issues, and I do question, was he the right man for the job?
He's gone.
I don't think so. So there could finally be a turning point potentially for Tyson Foods.
I think that's all good news, and I think there could be some potential here because remember the chicken, the chicken flu, I mean, they've gone through so many things. Could be the time to look at Tyson Foods.
Yeah, hopefully they're at that bottom and looking up.
Yeah. All right, we're gonna take a quick break here. When we come back, we're gonna talk about Lockheed Martin, Generac, and Seagate. Stay with us. You're listening to the Smart Investing Show with Brent and Chase. We'll be right back. All righty. Welcome back to the second part of the Investing Show, Smart Investing Show. This is where we start off the show. We do have the companies Lockheed Martin, Generac, and Seagate. We'll talk about that. But before we get into that, we're going to talk to our financial planner, our CFP, Harrison Johnson. Harrison, glad you're here.
Always.
We're talking about this new plan coming out. Mortgage-backed security purchases, lower mortgage rates. Makes sense, but let's explain it to people.
So this is some news that came out recently. It looks like Fannie Mae and Freddie Mac are going to be purchasing $200 billion worth of mortgage-backed securities. So essentially what that means is Fannie Mae and Freddie Mac, or let me back up. When you get a mortgage, you get a mortgage through a loan officer, and they source the money that you're borrowing from different investors. And so once you get that mortgage, those investors often then sell those mortgages to places like Fannie Mae and Freddie Mac or other investors. And so with Fannie Mae and Freddie Mac coming in and now buying $200 billion worth of mortgage-backed securities, that is going to add demand to that market. And so now with loan originators and investors selling to Fannie Mae and Freddie Mac, they can sell them so they don't need to charge essentially as high of a mortgage rate up front. So this is something that's going to bring mortgage rates down essentially directly. And today with the news coming out, we saw that mortgage rates, 30-year mortgage rates got down below 6 without any points. So essentially par value got down below 6 for the first time in about 3 years or so.
Yeah, and this is definitely good news, and it does make sense because you buy those loans, the demand is there. The supply is not like, because it's the other side, which I was concerned about. And it's like, well, that's been wiped out now, because I thought, well, no, the short-term rates are not going to bring down mortgage rates, but that's not happening. This is something different. They're now working with a long-term rate by buying those loans.
And that's the distinction, because what the Fed does, adjusting interest rates, generally has more of an impact on short-term loans. And so, the Fed has been cutting rates, and people are saying, well, when is that going to trickle into 30-year mortgages? Because they've been coming down, but not really that much. This is something that the direct result is to try and bring those 30-year mortgages down.
And I want to know, too, I don't know if either one of you know, I mean, $200 billion is a lot of money, but I think the mortgage market is a multi-trillion-dollar market.
It's huge. This is something similar that was happening during COVID. So during COVID, the Fed was buying mortgage-backed securities to a much larger extent, but that was one of the reasons why mortgage rates were so low at that time. Not only had the Fed reduced rates, so borrowing rates were low for most loans, but also the Fed was buying mortgage-backed securities. At that time, they were buying a lot more than $200 billion. It was like $500, $600, $700 billion worth. But this again is something that we should start seeing some lower mortgage rates.
I just ChatGPT'd it, so it looks like it's about $9.2 to $9.4 trillion is the mortgage-backed securities market.
So I guess the question is the $200 billion going to be enough to move it longer term or just short term, I wonder?
I mean, net, it's still obviously, I think, going to be positive. And they didn't release, I don't think, how quick they were going to do that $200 billion either.
Right, you're right. That's something, too, because if they go and buy a lot quickly, it could bring prices down, but then once they're done buying, those prices could then, or the interest rates could, go up slightly. So I'm not sure on the schedule that they're going to be buying it.
And do you have the number as well of how much the Fed purchased during COVID?
I saw a number today that was like close to $600 billion.
Okay. Wow. So, I mean, that is something, too, because when you look at, obviously, the Fed did multiple things during COVID, and we had to slow down the economy, so people were rushing to buy, the safe trade, to buy fixed income. So that really helped the market. But, I mean, the low, it looks like, for the mortgage rate, do you remember what it was?
Oh, gosh, that was like 2, wasn't it?
Yeah, 2.65. Looks like in January 2021 was
we
the
won't see
low.
that.
No, we won't see that from this.
Don't be waiting for that.
I see people come in and they show me their mortgage statements. It's like, under 3. We're not going to see that again for a while.
And I do know, kind of looking at some of the details with the Fed cutting rates, it long-term should help mortgage rates. Short-term, it might not. But as the Fed kept and keeps cutting rates potentially, people will start to chase yield further out on the yield curve, which should help create more demand there. If you're getting, let's say, 2%, just making numbers easy in your savings account, you might be like, I'll buy a 10-year treasury now for 3.5 to get that higher yield, and that should create that demand. So it might not be an immediate impact, but if the Fed does keep cutting rates, the Fannie Mae, Freddie Mac, they do more of these buys. I mean, you could see some benefit to mortgage rates.
Yeah, and again, the rates that we saw as a result of this, mortgage rates on the 30-year went under 6. Now, you might be saying, well, I talked to somebody and they got a 30-year mortgage recently in the 5s. The reason they were able to do that is because they were paying points to buy down that rate. Either they themselves were doing it, or maybe they were seller financed. So the seller was essentially buying that. So what this is saying is, without any cost or buying that rate down, the par value of 30-year mortgages is dipped under 6%.
And I think we talked a few weeks ago, too, about how the new home or the builders are actually buying those down.
Exactly. So, a builder will have a community of houses that they build, and then they're selling those, and they essentially have some of the proceeds of the sale go toward buying down those rates. So you can get into, a house and your mortgage rate is 5% or, something like that. But the reason it was so low, again, because it was being bought down. This, is not a result of it being bought down. It's just the actual value that interest rates are coming down.
Yeah, and I think this is definitely good news for the economy, for people who want to buy a home and so forth. I don't know, maybe you know or have a thought. This could increase the prices of homes again, which puts them back out on the street.
I think it could. I think the people that benefit the most out of this are people who bought or refinanced homes within the last 3 years, because this is going to give you an opportunity to refinance that. If you had a mortgage before that and you're locked in at 2, this doesn't matter. If you are looking at buying a house, this means you could potentially afford more, but that means everybody else can too. So
Right.
we'll see what the impact on the housing market is on this.
Just the only thing that I've kind of read, and this is just really loose reading, is that it shouldn't move the price of the home up that much. And that the reason being is the affordability has just gotten so out of whack that even if rates were to fall to, like, I think there's a study done at 4.99, it actually wouldn't increase affordability enough for like a large set of the population to now step in and buy homes. The big hurdle has been that down payment, and then also too just the affordability component has been so challenging that the people that can buy houses have, and the people that can't buy houses have such a big gap to make up. And so what this tells me is the people that benefit the most is the people that bought the last 3 years, because now they can refi and get a lower payment. But what that then does is it doesn't necessarily push demand higher for homes, so home prices shouldn't accelerate too much.
So we're not going to expect a big rush to home sales going dramatically through the roof.
I don't think so. I think, right now there is a little bit larger supply of homes on the market, so some of those could have been purchased up. But yeah, you're right, Chase. With people refinancing, that's not a real estate transaction. So it's mainly just people refinancing or, cashing out for refinances or whatever they're doing.
I don't think it decreases home prices, but
I
don't
don't
look
think
for
so
a
either.
5 to 10% increase in your home price
Right.
either.
Right.
So, well, here's some good information. Thanks for being with us and sharing that. And if you want to have a conversation with Harrison, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. And he is a fee-based financial planner. He does not try to sell you annuities or life insurance. His job is to lay out a full financial plan for you, talk about taxes, cash flow. Can you afford that home? He just does a great job. You hear him here every week with different topics. So give him a call for that free consultation. All right, Chase, we ready to talk about, Lockheed Martin?
Yeah, let's look at Lockheed.
All right. Lockheed Martin and obviously defense contractors in the news as well here. But Lockheed Martin, their aerospace and defense contractor, short is only 1.5%. So nobody expects this to go down. 75% institutional owned. PE ratio is on the high side. It's 30.3, but the whole industry is high. And I think that's because Trump is in office, that everybody knows defense is going to be a good place to be. Price to sales, 1.7 versus 3.2. That is a positive. Price to book value, 20.3 versus 7.8. Price to cash flow, 20.1 versus 34.4. PEG ratio does look very good, though. 1.1 versus 7.5 means you're not paying much or very much for the future growth of the company. Now, this is surprising to me. Over the last year, earnings for Lockheed Martin are down 19.5% when the industry was up 15.7%. Maybe they had a write-off or something. I don't know, but that's a big drop compared to the growth in the industry. Sales for Lockheed Martin were only up 3.2%. I say only. That is actually better than the industry at 0.6%. And I love this 5-year growth rate from the analysts on earnings. So for Lockheed, it's 19.7%, and the industry is 15.7%. So the defense industry should continue to grow and do well. We do see that they pay a dividend, decent dividend, 2.5%. Use 73% of their earnings to pay that out. On the balance sheet, the current ratio is 1.1 versus 1.6. That's okay. The debt to equity is kind of high, though, 3.6 versus 0.7. I'm trying to think quickly why that would be. Could just be a lot of capital and investment to build the bombs and the planes or whatever they're building, but that's pretty
They
heavy.
build the fighter jets is their big kind of claim.
Yeah.
The F-35, I think, is their
F-35.
their main
Yeah.
kind of like thing that people know.
Yeah, that's a heavy debt. I'll try to look at it when you're looking at some other numbers to see if I can see something that stands out on the balance sheet, why that's so high. We do say they have a net profit margin 5.7, just about the same as the industry at 6. Return on equity is very good, 68% versus 17.6. So maybe they have a very low equity with normal debt. That could be the reason why that number looks strange on the debt to equity. We do see, free cash flow, $4.6 billion, about twice the industry at $2.2 billion. Things are looking pretty good except for that debt to equity.
Yeah, and I did want to kind of bring up before we get into the numbers here. Looking kind of at the general story, the reason they've been in the news this past week is, Trump came out with a defense budget, or a dream defense budget, I'll call it, of $1.5 trillion in 2027.
Is it like $1 trillion now?
A little bit under $1 trillion, yeah.
Wow.
So it's a big increase. And he said he wanted to, again, build a dream military is the goal there. And I want to point out that the president's wishes are not reality, right?
Yeah.
I mean, now he has to push this agenda and idea through Congress. And I believe that $1 trillion has not even been cleared yet. Right now, there has to be that reconciliation done in Congress, and that has not been finalized for us to even get to that point. So to now push through a $1.5 trillion budget for defense, that's going to be challenging, I think, for 2027, especially if Congress looks different next year.
And what do you think of him saying, okay, I'll ask for $1.5 trillion. If I get $1.2 trillion, I'll be thrilled.
It depends on Congress next year. I
Well,
mean, if
well,
the
but
Republicans lose the House, I
Oh,
think
yeah.
good luck with that. I think
Yeah.
you're going to be very hard-pressed to even maintain defense at where it is now.
Yeah, it would stop all the good stuff we're seeing right now.
Well, and the thing that I look at with this particular news story is I wouldn't be buying into the hype, because I think the excitement around that $1.5 trillion number is excitement at this point. Is it going to be reality? I don't think so. I think 1.5 is a high watermark.
And I won't take it away from you, but the year-to-date number is ridiculous.
Oh, yeah.
It's only a week. Yeah.
Yeah, well, let's look at the numbers here for
Sure.
Lockheed Martin. Again, their ticker symbol LMT. Current price $542.92. 52-week range $410.11 is the low. The high $546.07. That was hit on Friday. As you said, year-to-date return so far, just we'll call it one weekend, 12.3%. So, gosh, that's been a great start to 2026.
Yeah.
Looking longer term, though, for this stock, over the last 5 years, you've done well, up about 61%. And over 10 years, your return has been about 140%, not including the dividend. So, I mean, you're probably pushing 200-ish%
Yeah.
over the last 10 years. Looking forward, though, for the company, this is where I'm going to say the disappointment comes. Going out to December 2026, estimated earnings per share of $29.01 gives a target sale price of $481.57. So, again, that current price, $542. Sell price $481. That's not a good spot to be for a value investor, in my idea.
And I was looking at the balance sheet, and somebody messed with my balance sheet, because it used to be the left was the most recent number. Now it's all the way to the right, so we're going to correct that because it's hard to find it. But I just want to look real quick at the equity for Lockheed Martin. It's $6.1 billion, and the debt, the long-term debt, is $20.5 billion. That seems to be the norm. Back in June 24 is about $19 billion. More research needs to be done. That's just a lot of debt. I get worried on that.
And there are some negatives as well that Trump has brought up with these defense companies. He has talked again about limiting compensation for the CEOs. He's talked about limiting buybacks and dividends for these companies. And also, too, we can't forget that Trump is a negotiator. He doesn't want to pay the highest price for the F-35. He wants more realistic margins for these defense companies. So if he comes in and says, yeah, we're going to increase the budget to $1.5 trillion, but we're not just giving away $1.5 trillion, you have to give us something back as well.
Right.
That might not be super beneficial for the defense companies. Their sales might increase, but their margins might contract as well. So there's, I think, some puts and takes here, and I definitely wouldn't be overpaying for the earnings, the sales, and book value of these defense contractors.
Yeah, I think the time to buy them was probably about a year ago. I think now the ship has sailed, so to speak. And do they make ships anymore?
No, I think that General Dynamics is the big ship maker. Again, the only thing I know about Lockheed is the F-35.
F-35, yeah. But I don't think they make ships the way they used to. I mean, they were a big thing years ago, but now drones is the big thing. So, all right. Should we move on to who are we going to do next?
Generac.
Yeah, Generac. You know, it's funny, this company Generac, you know, I haven't seen them lately, but I used to see the commercials all the time. For their generators that they do and stuff. And it made a lot of sense, especially me in California. We do have irritates me, we do have a generator, natural gas generator. I bought it a year ago. I'm embarrassed to say I still have not had it hooked up yet. I did buy one in case.
You're going to wait until you need it, and
Yes.
you're going to be like, oh.
Yeah.
'Cause
Ron, why didn't you hook it up for me?
I've thought about, man, I need to get a generator because, you know, here in California, when they shut off your power, I have like, my wife and I, we buy like big bulk beef shipments. And if like my freezer were to not be allowed to run, I'd be screwed. All that money I invested in the cow would be totally wasted. So I probably need to get a Generac generator.
You might have to look. I think they're high priced, but let's look at the company, see if it's a high price or good investment or not. They are in the special industry machinery industry. Shares float on the higher side, 8.3, 94% institutional owned. PE ratio is high. It's 29.2 versus 13.3. Price of sales, 2.1 versus 1.3. Price of book value, 18.7 versus 418, so that is a positive there. But price of cash flow, not so good, 15.4 versus 9.7. The PEG ratio does look good, though, 3 versus 29.7, so it does say that you're paying less for the future growth of this company. Moving on to the earnings per share growth over the last year, it was down 2.8%, but the industry was down 4.1%. Sales for Generac were only up 1.3%, while the industry experienced a 135% gain on their sales. 5-year growth rate on the earnings is a 7.6% for Generac and about 3.9% for the industry. Disappointed here. They do not pay a dividend. I thought they would, but no dividend. Look at the balance sheet. Current ratio, very good, 2.2 versus 1.7. Tells me they should be paying a dividend with that much cash there. Debt to equity, 0.6, same as the industry. We do see a net profit margin, 7.1 versus 8.5. Return on equity, not where we want it to be. We like around 15. It's 11.8. And their free cash flow is kind of suffering, $424 million versus $4.2 billion for the industry. So I'm not getting too excited about Generac here.
Well, looking at the current price for Generac, it's $152.78, and I'm kind of blown away by how volatile the stock has been. Looking at the 52-week range, the low here, $99.50, and the high, $203.25. But I'm not going to say that's where the volatility really is. If you look over the last 5 years, it's actually down 41%. But over the last 10 years, you're up 444%. I mean, the stock in 2021, I don't know what the heck was happening, but it went over 470. Looks like it was approaching $500 a share.
Well, that was during COVID, so maybe people were
post-COVID. Yeah, maybe people were buying generators just in case they weren't leaving the home. But I mean, that was still. Yeah, I mean, I guess people were still worried at the end of 2021.
And I see another high year-to-date number.
I mean, looked at year-to-date. Year-to-date, another one up 12%. This one has gotten actually 2 upgrades this week by 2 different players.
Okay.
And the one that was kind of interesting to me, gave a little bit more information, was from Baird. And they said the firm is looking at the company as having a number of unique catalysts ahead, including the opportunity presented from commercial and industrial diesel generator sets. So again, is this another potential AI play, so to speak, to generate that power that is needed? And it looks interesting when you're looking at that earnings growth for this business. I mean, you go out to December 2026, I see estimated earnings per share here of $8.23. It gives us a target sell price here of $136.62, so not quite the valuation that we want to see given the current price is $152. But earnings growth is supposed to be like 25%. And then going to 2027, they're looking for earnings growth again of 20%. So, I mean, there is some potential growth here that these analysts are looking for. Maybe, again, an AI play that isn't as prominent as people are thinking.
And I was thinking residential, but you brought up the point that with all the shortages of energy and so forth, that they're also looking at the data centers, the commercial side, everything else there.
Yeah, and I'd be very curious. I mean, I see just on their website, they have residential and industrial right at the top of the page. Yep. So I'd be curious what that split is between those 2 sectors, how much comes from industrial. And I mean, the other thing to point out as well, as we talk about even these data centers, it might not seem like it, but it might push residential people to buy generators because of electricity prices continuing to climb. So, I mean, this could be a play that could be because of the large push to data centers and the amount of power that is going to be needed to have those data centers actually functioning.
Yep. So,
but again, I wouldn't buy it because the valuations are still a little bit stretched for where we'd like to jump in.
It looked like it could have some potential, but just not there.
But as I said, I might be buying that generator for my home.
Buy the generator, don't buy the stock, right? Yeah, at least a small one to put in the garage so that you can at least plug it in.
Yeah, at least plug in the
freezer.
The freezer.
Well, let's move on before we run out of time here. Let's talk about, and this industry has just exploded recently. We're talking about the computer hardware industry. We're going to be looking at Seagate Technologies. Gosh, this stock did nothing for years. We'll talk about the performance of it, but the symbol is STX. Their PE ratio now is 39 versus 40.6 for the industry. Price of sales, wow, 7 versus 1.3. No book value, tangible or otherwise, no book value for Seagate. Their price of cash flow, 44 versus 18.9. PEG ratio, 1.8. That's good compared to the industry of 5.9. Now, their earnings over the last year are up 41.6% versus a decline of 12.4% in the industry. I think this industry is pretty wide with the computer hardware industry because they're more memory storage. Yeah. They should kind of have, I think, in my opinion, their own separate industry because it's too broad with the computer hardware industry.
Yeah, I mean, is that like lumped in then with like Hewlett Packard?
I think so. No? Yeah, Dell, everything else. Yeah, a lot in there with the computer makers. The sales for them up the past year, 19%. That's very positive. Again, industry down 14.5. The 5-year earnings per share growth estimate is 14.1 for Seagate versus 9.2. Now, they do pay a small dividend, 1%. They use 35.7% of their earnings to pay that out. And I guess that was much higher probably not too long ago when the stock was much lower because now with a big increase in stock, your yield drops. Stock price goes up, yield will drop because of the what it costs for those shares. Payout ratio now is about 53% on the free cash flow side. Look at the balance sheet. We got a current ratio of 1. That's below the industry at 4.3. No debt to equity, so I'm assuming, I'm going to guess, I'll look at it, but I don't think they have any equity. We do see a net profit margin, very good, 17.9%. That's well above the industry at 3.4. Return on equity, a negative 2,719 versus a positive 35.1. My guess is they probably have no equity, or again, very little equity. And then we do see free cash flow, $1.2 billion versus $2.9 billion for the industry. Chase, what do you got going forward?
So current price here for Seagate Technology Holdings, their ticker symbol again, STX, is $304.01. 52-week range low here, $63.19, and the high $332. And so far this year, it's up about 10%. But it seems like every day it's like up 8%, down 8%, up 7%. I mean, it's just been a crazy trade, and people, I think they're trying to take profits. I mean, over the last year, it's up about 220%. So, I mean, there's been a lot of hype kind of circulating around this. I don't know enough about this space. I don't know enough about technology to understand why this space is as exciting as it is.
And I remember years ago, like it was flash memory. It was kind of like outdated. They had new stuff. It seems like all of a sudden something's changed. We're like, wow, this is the next great invention here they've got.
Yeah, I mean, because for years this was like a value trap, right? It would trade at like 8-10 times earnings, and it's like, wow, I wish we would have bought this for the value.
Well, this is where we talk about being patient. I mean, if you were patient a few years, you've done very well. So,
I mean, your 5-year return up over 400%, your 10-year return up over 821%, and this is one used to have a great dividend. As you said, only now 1%, but obviously with the huge increase in the stock price, if you bought this 10 years ago, I mean, you were getting good yield on it.
Yeah.
Looking forward, though, for Seagate Technology, we go out to June 2027. I see estimated earnings per share here, $15.29. That gives us a target sell price, actually more reasonable than I thought it would be. But target sell price here, $253.81. The forward PE, not a value company at over 18 times earnings. But frankly, I thought this was going to be in the 30s, 40s in terms of the valuation. So, there is that component, but I mean, I don't know, again, enough about that business, but they're looking for earnings growth here, 43% this year, 32% next year. I don't know what's changed in this business, but I mean, there is definitely that hype around this company, and I think other players as well.
Yeah, I've not heard anything specifically why all this hype is gone. I did look at the balance sheet. Their equity is a negative $63, I think that's $1 million. They do have a lot of debt. Their long-term debt is about $3.5 billion. The balance sheet doesn't look that good, but they're making a lot of money, it looks like.
And I just got to point out, I mean, the player in the space that has just been the most intriguing is SanDisk Corporation. They were spun off in February from, another kind of competitor to Seagate, which was Western Digital. SanDisk, since that spin-off in February, is up, let's see, think it's, gosh, where is that number? Of course, it's not working. It was spun off around $27, $28, and now SanDisk is at $377 a share. Year to date, this stock, SanDisk, it's up 58%. It looks like, holy cow, that
Year
can't
to
be
date?
it. That's
Wow.
what it's saying. I mean, gosh, this thing is just crazy.
I mean, obviously, we're going to tell people, I mean, this is not a buy. I
No,
mean, it's a speculation is what it is, speculative move. It could go higher. But also, too, before you even consider it, you got to find out what's going on in the space. I mean, this is some type of memory. And I'm trying to think, is there something to do with AI that's why they need more memory? I mean, this is
assume.
short-term memory, not long-term memory.
Yeah, I mean, we talked about Micron last week or 2 weeks ago, and kind of the volatility in earnings with that space. I'd assume there'd be something similar here. You might be in a nice earnings growth cycle, but again, if it's going up 30-40% a year, there's potential that earnings could collapse. Maybe a few years from now.
Yeah. Well, there you have it. So, all right. Well, thank you for listening to the Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great information there for you. The newsletter, sign up there. Thanks for listening. We're back next week right here on the Smart Investing Show.